Number 1. Aggressive investing. Aggressive investors invest in high-risk companies, expecting a very high return on their investment when those companies become profitable and appreciate in value. They have a very strong risk appetite. When it comes to investing, they are absolutely fearless. If 90% companies they invest in fail in the long run, they still make a lot of money because the other 10% of the companies may grow 1,000 times or more. They mostly invest in small-cap stocks, stock options, and innovative companies in the emerging markets like India, China, and Brazil. They also invest in private equities. For example, Uber, before it became a public company. Number 2. Concentrated investing. How many investable ideas are there in the stock market today? 10, 20, 30? But only the Nasdaq and the New York Stock Exchange offer more than 5,000 stocks. Then there are ETFs, index funds, mutual funds, and cryptos. Why invest in so many companies when you can achieve your investment target by holding only 3 to 4 companies at best? If you consider the Bank of America, Amazon, Starbucks, and Disney as great companies, put all your money in them. Start investing any day and continue investing throughout your life. You will be rich. Investment portfolios that earn the highest returns for investors are concentrated. It is not a surprise that Warren Buffett has 40% of his Berkshire portfolio invested in Apple. Number 3. Contrarian investing. If you are a contrarian investor, you buy when others are selling, and you sell when others are buying. You go against the market. You love recessions, sell-offs, downturns, whatever you call it. You pass a lot of time researching companies to find the ones that will earn you a return that will exceed the return everyone around you can gain by following the market. When everyone is happy, watching the market making record highs, you anticipate that the market will decline soon. You wait and open your purse only after the market has fallen enough. As a contrarian investor, you hold your positions longer than swing traders and short sellers. Your patience pays off when the market becomes bullish again. Number 4. Growth investing. As a growth investor, you do not believe in average return. You believe in above-average return. You look for companies that will lead their industries one day. You invest in smaller and younger companies and expect them to increase their profitability drastically over time. These companies have innovation at their heart. They mostly work in the technology and biotech sectors. Next time you hear a biotech company had one of its vaccines approved by the FDA, you know what has happened. These companies' share prices are low, but they may be considered overvalued. Invest in them because they have competitive advantage in the market. Number 5. Value investing. Value investors pick stocks that are trading far below their intrinsic or book value. Some of the metrics they use to research stocks include price to book, forward price to earnings, and enterprise value to cash flow from operations. These stocks are not cheap, but cheap compared to their peers. Don't buy cheap stocks until you are absolutely clear they are value stocks. Otherwise, you'll be in what is called the value trap. Value investing is completely opposite of growth investing. You do not go for high alpha companies. You go for companies that are having a bad time or bad publicity. They will stand up again and, in the process of doing that, will make you rich. It is like going to the supermarket looking for the best products selling at a cheaper price. Number 6. Buy and hold investing. As the name suggests, the buy and hold investing strategy is meant for investors mostly passive in their investing activities. They don't buy often, and they rarely sell. They invest long-term to enjoy a tremendous return on their investment. They choose solid companies with excellent fundamentals, companies that have regular cash flows, companies that are predictable and will not go bankrupt. Their purpose is not getting rich overnight, but to be certainly wealthy little by little. They don't sell their stocks during any downturn, and by doing that, outperform active fund managers. You cannot time the market, they believe. Let time correct your mistakes. You cannot go wrong with this strategy. This is the strategy any new investor should follow. Once you have built a sizable portfolio, you can always start investing more, following any other investment strategy. Number 7. Index fund investing or passive investing. Within a decade, the index fund investing has become almost equal to commercial investment funds in the United States. It is the most low-cost way of investing. You don't need to buy 500 stocks to gain the best returns from the market. Instead, buy only the S&P 500 index fund. You also don't need to diversify your portfolio. The fund already has 500 great companies within it. You also don't need to do research. Leave that for the professionals to handle. Invest your money little by little, and you are happy to understand that nobody ever lost money by investing in the S&P 500 when invested long-term. There are other funds as well. For example, Nasdaq 100 and Dow 30. Choose any one or two funds and start investing. Time is money. Start investing as early as possible. Number 8. Income investing. Income investors design their portfolios to generate regular income from their investment. These investors buy assets like dividend stocks, bonds, money market accounts, CDs, real estate investment trust funds, and GICs. Which ones you will buy will depend on your budget, risk tolerance, and the amount of money you want to earn in a certain period of time. It has two specific advantages. You can earn an income while the asset remains in the market. If your investment increases in value over time, you can sell them for a profit. However, understand that certain specific variables will impact the rate of your income from time to time. For example, market volatility, high inflation, high interest rate, and dividend cuts. Number 9. Conservative investing. The main purpose of conservative investors is to protect their capital. They invest in very low-risk assets. These assets may include dividend stocks, corporate bonds, municipal bonds, preferred shares, and money market funds. They also invest in index funds. When they choose stocks, they choose companies with low cost of production. They are not only interested in the products, but also in the people behind those products. People operating the business must be talented. Besides, the company must produce something that cannot be easily produced by other companies. For example, Coca-Cola and Walmart. Do you think it is going to be easy to beat them by a new competitor? Finally, number 10. Momentum investing. Momentum investing has two parts: going long and short selling. When you see an upward price trend in the stock you like, you will purchase the stock and hold it until the trend comes to an end. On the other hand, you will sell the stock when you notice a downward trend. Once the stock falls, you will buy the stock to close your short position, thus making a profit. The concept is based on the simple truth that a well-established trend is likely to continue. You need some experience about price action to be successful in this strategy. You need to know how to time the market and manage your risk. In the absence of any of these two, you may lose a lot of money. It is an advanced investing strategy, but it can be highly rewarding if done right. Before investing any money in the stock market, understand what kind of an investor you are. It is too important. Then you choose the right asset or stock and the right strategy to invest in them to be a successful investor.